Stop what you're doing because what happened last Friday wasn't a normal pullback. It was a trapdoor. Gold slipped, silver got body checked, and the rest of the shiny complex, platinum and palladium, followed like dominoes. And here's the part most people are missing. The move wasn't random. And the next 48 hours could decide whether silver miners are about to become a gift or a graveyard. Before we even touch the miners, we need to clear the fog. There's a rumor flying around that a huge Wall Street bank closed all its shorts at the low of the day. The story goes like this. They slammed the market down, then quietly exited at the bottom, and now they're about to let silver rip higher. Sounds juicy. Sounds like a movie plot. And it's exactly the kind of thing that spreads like wildfire because it feels satisfying. But here's the catch. Most people are reading the wrong document, and they're reading it the wrong way. That report is only for one single delivery month, one slice of the calendar. Even if you could perfectly interpret who issued and who stopped on that day, it wouldn't tell you what's happening in the next month where the bulk of open interest sits. It doesn't tell you whether a position was opened yesterday or carried for months. That's why I don't treat delivery data like a fortune cookie. It's a temperature check, not a prophecy. Deliveries can jump because an industrial buyer wants to lock in supply now, or because a fund wants bars instead of cash, or because a broker is netting client flows. Real possibilities that have nothing to do with some cinematic short cover story. So when you see a rumor go viral, ask yourself, is this information or is it entertainment? Because markets punish people who confuse the two. Every trading day, the futures market spits out a plain boring report showing who delivered metal and who received it for a specific contract month. It's not a secret decoder ring, it's a receipt. People saw a big bank's name attached to a few hundred contracts and screamed they covered, except receiving metal and covering shorts are not the same thing. When you see a bank on the receive side, it means the broker arm is involved in taking delivery for that month's contract. Could be for the bank itself, a customer, a manufacturer, a refiner, or a hedge fund that decided, forget paper, I want bars. What it does not automatically mean is that the bank closed a short position. If the report shows them taking delivery, that's consistent with being long into delivery. That's the opposite of the headline people are spreading. And even if a few hundred contracts were related to covering a short, let's keep our feet on the ground. A few hundred contracts is a rounding error when the biggest players have giant balance sheets and layers of exposure spread across months, options, swaps, and off-exchange deals that never show up on a simple daily delivery line. So if your entire trading plan depends on one screenshot, take a breath. The really important question isn't did some bank do a thing? The question is what did price do? What did miners do? And what does the next set of earnings do to expectations? And that's where this gets interesting. Friday's move was violent. Silver dumped hard in a single session, slicing through levels that had only been broken recently on the way up. It felt like the floor disappeared. The kind of candle that makes your stomach drop. But when you zoom out just a little, something sneaky shows up. The silver price finished Friday around the same zone it traded at roughly 2 weeks earlier. In other words, the market erased a chunk of the recent sprint, not the entire trend. Now look at the Silver Miners ETF, basically a basket of the larger silver mining stocks. That basket fell too, and landed back near the same area it was trading when silver was at this level a couple weeks ago. At first glance, that seems simple. If the price was fair, then it's fair now. But I don't fully buy that conclusion, and here's why. 2 weeks ago, the market was in a different emotional climate. Momentum was building. People were chasing. Options were getting bid up. Everyone was high on the straight line up story. Now fear is back in the room. Stop losses got hit, weak hands got shaken out, and when volatility jumps, the market changes how it values everything, especially miners. Because miners are basically leveraged plays on the metal with operational risk stacked on top. So yes, the price might be similar, but the psychology is not the same. And psychology is what determines whether Monday turns into a bounce, a dead cat fake out, or the start of a bigger shake. And I'm telling you right now, Monday is going to be a roller coaster. You're going to see candles that look like heart monitors. 1 hour it'll feel like the crash is over. Next hour it'll feel like the world is ending. And if you try to day trade it, you can get chopped into pieces, even if you're right on direction. Here's what usually happens after a violent move. First, you get the emotional aftershock, the panic sellers are out. Then bargain hunters step in. Price pops. That pop triggers FOMO. People chase. Then price whips back down and triggers stop losses again, then it rebounds again. It's not a straight path, it's a yo-yo. And the yo-yo is designed to punish impatience. So if you're sitting there with cash because your stops got blown out on Friday, you're not alone. A lot of people got forced into cash without choosing it. And cash feels safe for about 5 minutes. Then you remember what cash is in a world where governments run deficits like it's a sport. Debt expands. Currency supply expands. Purchasing power leaks away quietly. And you can pretend it isn't happening, but the grocery store doesn't pretend with you. So people look at their cash pile and think, I have to do something. And Monday looks like the moment. But here's the cliffhanger you need to respect. Monday might be the worst day to make an emotional decision, because it's the day the market tests your patience. I'm not telling you to buy. I'm not telling you to sell. I'm telling you the environment is dangerous for anyone who needs instant validation. Me personally, I'm not doing anything on Monday. I didn't nail the crash. I didn't predict the exact timing. And I'm not going to pretend I'm a wizard, because I'm not. But I can tell you how I think about it. When metal prices crash on paper, the first question I ask myself is, did my physical ounces disappear? I can look at the silver I own, and it's still the same count. The bars didn't evaporate. The coins didn't melt. Nothing physically changed. What changed was the screen. And screens can lie to you in the short term. Now, does that mean price can't go lower? No. Price can always go lower. The market can always make you feel stupid for longer than you expect. But here's the thing. If silver hadn't sprinted so hard in the last couple weeks, Friday wouldn't have felt like an apocalypse. It would have felt like an annoying down day inside a bigger uptrend. It felt extreme because the move up was extreme. That's why you have to separate emotion from structure. So let's talk structure. Should you be buying silver miners here? I'm going to answer that, but not with a one-liner, because miners are not silver. Miners are businesses. They have costs. They have management teams. They have debt. They have jurisdictions. They have dilution risk. They have surprises, and that's why a metal bull market can still produce minor disasters. But it also works the other way. When silver rises, it doesn't just add a little profit to a miner. It can add a lot of profit fast, because many costs move slower than the selling price. Most primary silver miners aren't truly pure silver businesses. Many also produce zinc, lead, copper, and gold as byproducts. That means their profitability can be influenced by multiple commodity streams at once, sometimes cushioning the blow when silver is choppy and sometimes magnifying gains when multiple metals move together. Also, miners report costs in different ways. Cash costs, sustaining costs, and all-in costs. Those numbers include labor, diesel, explosives, maintenance, royalties, and the constant reinvestment required to keep the mine producing. So the question isn't just, where is silver? The question is, where is silver compared to the miner's cost structure? And how does that translate into margins over the next 2 quarters? The basic point about last quarter's average silver price being much lower and the next reported quarter having a higher average is valid. But the deeper story is about timing. Markets don't wait for earnings reports. Markets front-run them. And after a big crash, the market often reprices expectations before the numbers even hit. So you need to think in sequences. Sequence 1, the last reported quarter. Many companies sold metal at prices dramatically lower than where silver has been trading recently. The reported margins might look okay, but not explosive. Sequence 2, the next quarter's reporting. That's where higher realized prices start showing up more clearly. If market levels stay elevated on average, the revenue line changes, and suddenly the same mine looks like a different business. Sequence 3, the quarter after that. If silver holds above prior ranges, earnings power can start to compound. That's when analyst estimates get dragged higher, often grudgingly, often late. And that's where the trap is. If the market panics out of miners right before the estimate cycle turns, you get a window where charts look horrible but fundamentals are quietly improving. That window doesn't stay open forever. Now here's the skeptical counterpoint. Higher silver prices don't guarantee higher miner share prices. Why? Because miners can get punched by things that have nothing to do with silver. Unexpected shutdowns, lower grades, political risk, rising energy costs, rising interest costs, equipment delays, or share dilution. A miner can be right on the metal and still punish shareholders by issuing more shares at the worst possible time. What I am saying is this. If silver's average realized price over the next couple reporting cycles stays materially higher than the prior cycle, the probability of earnings surprises increases. And earnings surprises are what re-rate valuations. Based on recently published numbers, demand pressures haven't magically vanished. Silver isn't just jewelry and coins. It's a critical input for electronics, power systems, and especially solar manufacturing. When solar build-outs accelerate, silver gets pulled into supply chains whether traders like it or not. And that industrial pull can show up with a lag. Now let's get practical. If you're considering miners, you have to decide what game you're playing. If you're trying to trade a one-day bounce, you're competing with machines, professionals, and chaos. Good luck. If you're positioning for the next several quarters, your focus should be on survivability and margin expansion. Survivability means low debt, decent cash position, stable operations, and mines that can keep producing even when conditions are messy. Margin expansion means selling price rising faster than costs. Energy is a big one. Diesel fuels the entire mining ecosystem. Explosives, hauling, grinding, energy touches everything. Labor is another. Skilled labor isn't cheap and doesn't get cheaper during commodity booms. And then there's currency. Many mines operate in countries where expenses are in local currencies, while revenue is priced globally. That can help or hurt. If the local currency weakens while metal prices hold, margins can widen. If the local currency strengthens, margins can shrink even if silver is flat. That's why miners can move in ways that confuse people who only watch the metal chart. Now let's bring it back to Monday. If you're looking for a clean signal, you won't get it. You'll get noise. But there are a few things I'd watch. First, does silver stabilize after the smash, or does it keep bleeding? The quality of the bounce matters. Second, do miners lead silver on the bounce or lag? If miners can't bounce when silver bounces, that's a warning. If miners bounce harder than silver, that can signal risk appetite returning. Third, do you see panic volume fade? After a big liquidation, volume spikes, then drops as forced selling ends. That transition can be a clue that the worst pressure is behind you, at least for now. And here's the cliffhanger. The next big move in silver often happens when everyone stops staring at it. That's not mystical, it's a positioning statement. When too many people lean one way, the market kicks the chair out. So right now after Friday, you have a mix of fear and opportunity. Which one wins depends on earnings, guidance, and the macro backdrop. Let's talk macro for a second. Silver tends to care about real interest rates, the return you get after inflation. When real rates are high, holding non-yielding metals is less attractive. When real rates compress or go negative, metals start to look smarter. And we're in a weird period where nominal yields can be one thing and purchasing power reality can be another. Even if headline inflation calms down, people still feel price pressure in daily life. That changes behavior, politics, central bank posture, and the risk people assign to holding currency. Also, the US dollar matters. When the dollar strengthens quickly, it can pressure commodities. When the dollar weakens, commodities breathe. Currency moves have been jumpy, which is what you'd expect when investors can't decide whether the next big theme is growth, recession, or policy whiplash. So if you're only watching silver in a vacuum, you're missing the levers. Also, keep one eye on companies that don't just mine but refine, recycle, or stream production. Those business models can react differently in drawdowns. Streamers can look boring until they suddenly don't because their costs are locked, while revenue floats with the metal. Recyclers benefit when scrap flows increase after price spikes. Refiners see margins shift based on throughput and contract terms. None of that shows up if you only watch the headline silver price, but it changes where money rotates when fear hits. Now back to the rumor machine. People love a villain and a hero. They love the idea that one big bank is controlling everything. Reality is messier. Yes, big players influence markets, liquidity is uneven, derivatives can amplify moves, but a lot of what you're watching is positioning, risk management, and forced flows. When markets get leveraged, they become fragile. A push turns into a shove, and a shove turns into an avalanche. That's why I'm more interested in what the crash revealed than who to blame. The crash revealed this. A lot of people were overconfident. They thought silver couldn't drop. They thought miners were a one-way ticket. They thought every dip was a gift. Friday reminded everyone that markets don't care what you think should happen. So if you're going to be in miners, you need a plan that can survive being wrong in the short term. That might mean smaller sizing, scaling in rather than going all in, focusing on higher quality operators instead of explosive lottery tickets. And yes, it might mean admitting you don't need to trade Monday. Now let me ask you two questions. First, do you think Friday's smash was a one-day liquidation event or the first crack in a bigger unwind? Second, if silver rips back this week, are you buying miners, buying physical, or staying on the sidelines until earnings confirm the story? Drop your answers below. Let's talk miners again because this is where most people get confused. They see silver at a certain price and assume miners must be printing money immediately. But miners sell production over time. Some have hedges, streaming agreements, fixed contracts, different mixes of byproducts, and report results on schedules that don't perfectly match your trading calendar. The earnings you're waiting for are like a delayed echo. And that's why the market loves to shake people out right before the echo arrives. When year-end results come out, you're going to see guidance, commentary about costs, updates on projects and expansions, and whether management teams act like owners or stock issuers. According to the latest filings, many mining companies have been emphasizing capital discipline more than in past cycles, meaning they're trying to avoid reckless spending when prices rise. If that discipline holds, shareholders might actually benefit from higher metal prices instead of watching management light money on fire. But discipline is a promise until it's tested. Now let me share how I'd think about buying miners if I were building a position. I'd split it into layers. Layer 1, the sturdy names with multiple mines, diversified production, and balance sheets that don't rely on perfect conditions. These are less exciting, but they survive. Layer 2, the mid-tiers with growth projects that can increase output without blowing up costs. These can move hard when the market believes. Layer 3, the speculative names, single asset stories, development plays, explorers. These are where people make and lose fortunes. After a crash, these can rebound violently or keep falling because financing dries up. If you're new, don't start with layer 3. That's how people learn expensive lessons. Now, what about the idea that the price was right 2 weeks ago, so it's right now? Here's the nuance. Price might be the same, but information changed. We just learned the market can drop fast. That increases the risk premium, increases volatility assumptions, changes how options are priced, changes how funds manage exposure. So even if a minor ETF is at the same price, the path that got it there matters. That's why I don't treat same price as same deal. But I also don't treat crash as game over. We could still be in a bigger bull market. Bull markets don't move smoothly. They climb a wall of doubt. They build skepticism. They punish late buyers. And they reward people who can sit still. The question is, can you sit still? Because the market is about to test that. Now I want to address something important. If you were holding physical silver before Friday and after Friday, the number of ounces didn't change. Same with miners. If your thesis is long-term, the ore body didn't vanish. But the market's vote changed. And sometimes that vote changes right before fundamentals catch up. That's why earnings matter. In past cycles, miners that outperform grow production per share, not just production. If a company doubles production but triples shares, shareholders lose. When you see growth plans, ask how they're paying for it. Cash flow debt or new shares? That question saves you pain. Why did silver fall so hard? One explanation is simple. When markets run hot, they attract leverage. Leverage creates fragility. A small push triggers forced selling. Forced selling doesn't care about value. It cares about surviving the margin call, so you get an air pocket. And in an air pocket, everything looks broken. But then the air pocket ends, and suddenly the world didn't end, and price can snap back. That's why I'm not rushing into hero mode. If you want to participate, think like a chess player, not like a slot machine. So what happens next? Path 1, silver stabilizes and earnings catalyze the next leg up. Path 2, we get whipsaws as the market can't decide direction. Path 3, deeper correction before the next move. Which is most likely? I don't know. Anyone claiming certainty is selling you something. What I'll watch? Physical premiums staying firm, open interest behavior, minor management tone, and industrial demand indicators. The energy transition still requires massive conductive materials. Silver has unique properties that make substitution hard. That gives the story a backbone. Now the cash question. Many of you are in cash because stops triggered or you panic sold. Sometimes cash is correct after a crash because it buys thinking time. But cash has a hidden cost when purchasing power erodes. You need a framework, not a vibe. Mine is simple. If I can't explain my position in one sentence, I'm not ready. If my only reason is, it looks cheap, I'm not ready. If my plan depends on Monday being green, I'm not ready. But if I have a long-term thesis, can scale in, and handle volatility, crashes become opportunities. Now let's talk miner profit math in plain English. A miner has a cost per ounce to produce silver. When silver rises from one range to a higher range, margins can expand quickly. That can turn a mediocre quarter into a surprisingly strong quarter. If the last reported quarter was produced at lower average prices, and the next quarter is produced at higher average prices, you see a step change. That step change leads to upgrades, and upgrades lead to re-rating. So the next time you hear someone say miners are cheap, ask them cheap compared to what margins, cheap compared to what costs, because cheap without context is just a guess. The biggest moves in miners often happen when they look unbuyable. Right after a crash, charts look ugly, headlines are negative, people are shell-shocked. That's when risk-reward can shift, but only for people with a plan. So what's my bottom line? If your time horizon is short and your emotions are easily triggered, Monday is a minefield. If your time horizon is longer and you're thinking in quarters, not hours, then yes, this kind of shake can create setups worth watching. But I'm not going to pretend there's a magic button. I'm going to keep tracking the story and updating you as data changes. Let's end with a simple action list. Watch price behavior on Monday, not just direction. Watch miners relative to silver. Watch for signs of forced selling fading. Watch upcoming earnings and guidance for margin expansion or cost blowouts. And watch yourself, because the hardest part of this market isn't the chart, it's your own impulse. All right, that's it for now. Stay sharp, stay humble, and don't let a screen bully you into bad decisions. And just so it's crystal clear, everything you heard here is for education and discussion only. I'm sharing how I think through markets, not telling you what to buy or sell. Make your own calls, do your own homework.